Breaking. A leaked internal memo from Morgan Stanley just hit my desk, and what I'm about to show you could shake the entire precious metals market to its core. According to this confidential document, one of Wall Street's biggest players is quietly liquidating all of their silver positions right now. We're not talking about a minor adjustment. This is a complete exodus from silver holdings worth potentially billions of dollars. But here's where it gets absolutely wild. Morgan Stanley isn't just selling, they're panic selling. The memo reveals urgent language, accelerated timelines, and instructions to exit at any cost. This isn't normal market behavior. Something massive is happening behind closed doors that retail investors aren't being told about. Is this a sign that silver prices are about to crash, or are they trying to suppress prices before a major shortage hits? The timing is suspicious, especially with industrial demand for silver at record highs and global supply chains still under pressure. I've got the leaked memo right here, and I'm going to break down exactly what it says, what it means for your portfolio, and the 3 scenarios that could play out in the next 30 days. This could be the biggest silver story of the year, and you're hearing it first. If you want to stay ahead of Wall Street's next move, smash that like button right now and subscribe so you never miss critical market intel like this. Let's dive in. So let me start by telling you exactly how this memo landed on my desk, because the story itself reveals just how nervous people inside these institutions actually are. 3 days ago, I received an encrypted email from someone who identified themselves only as a senior analyst at one of Morgan Stanley's commodity trading desks. Now, I get tips all the time, and most of them turn out to be nothing burgers, but this one was different. The level of detail, the internal jargon, the specific trading codes, this wasn't some random person trying to get attention. This was someone on the inside who felt compelled to blow the whistle on something they believed the public deserved to know about. The memo itself is dated from late December, and it outlines a comprehensive strategy to unwind Morgan Stanley's entire silver book by the end of the first quarter. Now, when I say entire silver book, I mean physical holdings, futures contracts, options positions, and even their exposure through various ETFs and derivative instruments. We're talking about a systematic dismantling of what was reportedly one of the largest institutional silver positions on Wall Street. The language in the memo is what caught my attention first. This isn't the usual corporate speak about portfolio rebalancing or strategic repositioning. The words used are urgent, almost frantic. Phrases like immediate liquidation, accelerated timeline, and minimize public attention appear throughout the document. Now, before we go any further, I want you to understand something crucial about how these major banks operate in the precious metals markets. Morgan Stanley isn't just a participant in silver trading, they're a market maker. They have access to information flows that retail investors will never see. They know about major industrial contracts before they're announced. They have relationships with mining companies that give them advanced insight into production issues. They see the order flow from other major institutions. When a bank like Morgan Stanley makes a dramatic move like this, it's not based on reading the same Bloomberg articles that you and I have access to. They're operating with a level of information asymmetry that would make your head spin. So the first question we need to ask is, what do they know that we don't? The memo doesn't explicitly state the reasoning behind the liquidation, and that's actually the most disturbing part. In normal market conditions, when a bank adjusts its commodity positions, there's always a clear rationale provided to the trading desk. Maybe they're bullish on another asset class and need to free up capital. Maybe there's a regulatory requirement they need to meet. Maybe they've identified better risk-adjusted returns elsewhere. But this memo provides almost no justification. It simply mandates the liquidation with an urgency that suggests something significant is driving this decision at the highest levels of the organization. Let me walk you through what I've been able to piece together from multiple sources over the past 72 hours. I've spoken with commodity traders, precious metals analysts, mining industry insiders, and even reached out to my contacts at other major financial institutions to see if they're seeing similar movements. What I discovered is that Morgan Stanley isn't completely alone in this. There are whispers, and I want to emphasize these are still just whispers at this point, that at least 2 other major banks have been quietly reducing their silver exposure over the past 6 weeks. The difference is that Morgan Stanley's move appears to be both larger in scale and more rushed in execution. Now, let's talk about what this could actually mean, because there are several scenarios here and not all of them point in the same direction. The first and most obvious interpretation is that Morgan Stanley believes silver prices are about to drop significantly. Maybe they have intelligence about a major economic slowdown that would reduce industrial demand. Maybe they know about new mining production coming online that will flood the market with supply. Maybe they've identified a technical breakdown in the charts that suggests a major correction is imminent. If this is the case, then their panic selling makes perfect sense from a profit preservation standpoint. They want to exit their positions before the market realizes what's coming and before liquidity dries up. But here's where it gets interesting, and this is where your analytical skills need to kick in. If Morgan Stanley genuinely believed that silver was about to crash due to fundamental supply and demand factors, would they really be panic selling? Think about it. These are sophisticated traders with advanced risk management systems. If they saw a price decline coming, they could hedge their positions. They could slowly scale out over time to minimize market impact. They could use option strategies to protect downside while maintaining upside exposure. Panic selling is what you do when you're facing an unexpected threat, not when you've identified a predictable market trend. This brings us to scenario number 2, which is significantly more complex and, frankly, more concerning. What if Morgan Stanley isn't exiting silver because they think prices will fall, but because they're facing some kind of structural risk in their positions themselves? Let me explain what I mean by this. Over the past decade, there have been persistent allegations, some of which have resulted in actual fines and settlements, that major banks have been manipulating precious metals markets through spoofing, wash trading, and other questionable practices. In fact, Morgan Stanley itself was involved in a settlement related to precious metals trading irregularities just a few years ago. Now imagine you're a bank that has built up enormous positions in silver, possibly using leverage, possibly through complex derivative structures that most people don't fully understand. And imagine that you suddenly realize that regulatory scrutiny is about to intensify, or that a major counterparty in your derivative chain is facing solvency issues, or that the physical delivery requirements on your futures contracts are about to expose the fact that you've sold more silver than actually exists in available inventory. In any of these scenarios, you wouldn't be selling because you're bearish on silver's price. You'd be selling because you need to exit before a structural problem in the market becomes apparent to everyone else. This scenario might sound far-fetched, but we've seen similar situations play out in other markets. Remember the London Metal Exchange nickel crisis in early 2022? Prices went absolutely parabolic because certain traders had massive short positions they couldn't cover when a squeeze developed. The exchange actually had to halt trading and cancel trades to prevent a complete meltdown. What if someone at Morgan Stanley looked at their silver book and realized they had exposure to a similar type of scenario developing and decided the smart move was to get out immediately, regardless of the short-term costs? There's also a third scenario that we need to consider, and this one is perhaps the most intriguing from a contrarian investment perspective. What if Morgan Stanley is liquidating their silver positions not because they're bearish, but because they know something is about to happen that will make physical silver extremely difficult to acquire, and they want to exit their paper positions before this becomes obvious to the market? Stay with me here, because this requires understanding the difference between paper silver and physical silver. The vast majority of silver trading happens in the paper market. Futures contracts, ETFs, allocated and unallocated accounts, derivatives, and various other financial instruments that represent claims on silver, but aren't actually backed by physical metal in a 1-to-1 ratio. The paper market for silver is estimated to be anywhere from 100 to 400 times larger than the actual physical market, depending on whose analysis you trust. The system works fine as long as everyone is content to trade paper claims and nobody actually demands physical delivery. But what happens when that dynamic changes? We've been seeing some very interesting developments in the physical silver market over the past year. Premiums on physical silver coins and bars have been elevated well above spot prices. Delivery times from major dealers have been extended. Some mints have reported difficulties sourcing sufficient blanks to meet demand. Industrial users are reportedly securing longer-term supply contracts to ensure they have adequate inventory. These are all signs of tightness in the physical market that is not fully reflected in the paper price. Now, if you're Morgan Stanley and you're holding massive paper positions in silver and you start to see signs that the physical market is tightening to the point where people might start demanding delivery in size, you have a problem. Because if you've sold silver futures or other derivatives that could theoretically require you to deliver physical metal, and that metal becomes difficult or expensive to source, you're facing potentially unlimited losses. The smart move in that situation would be to exit your paper positions immediately, even if it means taking some losses before the disconnect between paper and physical becomes so obvious that it triggers a broader crisis in the market. Let me give you some hard data that supports this possibility, because I know you're analytically minded and you want facts, not speculation. According to the most recent data from the Silver Institute, industrial demand for silver reached a record high last year, driven primarily by solar panel manufacturing, electric vehicle production, and various electronics applications. At the same time, mine production has been relatively flat, and recycling rates haven't increased enough to make up the difference. This means we're in a structural supply deficit. More silver is being consumed than is being produced. In a normal commodity market, this would drive prices significantly higher, but silver prices have been relatively range-bound. Why? The answer lies in the enormous overhang of paper silver positions that allow prices to be determined more by financial flows than by physical supply and demand fundamentals. But here's the critical point. A supply deficit can't continue indefinitely without eventually affecting prices. At some point, industrial users who actually need physical silver will start bidding more aggressively. At some point, investors will realize that paper claims on silver might not be as good as physical possession. At some point, the tension between the paper market and the physical market has to resolve itself. And when it does, anyone caught on the wrong side of that trade is going to face serious consequences. Could Morgan Stanley be positioning ahead of this resolution? Could they have intelligence from their industrial clients suggesting that demand is about to accelerate even further? Could they have insights into production challenges at major mines that aren't yet public knowledge? Could they be aware of geopolitical developments that might affect silver supply chains? Any of these factors could explain why they're exiting their positions with such urgency. Now, I want to shift gears and talk about what this means for you as an individual investor, because that's ultimately why you're watching this video. Whether you currently own silver, are thinking about buying silver, or have no position at all, this development has implications for how you should be thinking about this market. The first thing I want to emphasize is that institutional panic selling doesn't automatically mean you should panic sell as well. In fact, some of the best investment opportunities in history have come from doing the opposite of what panicked institutions were doing. When banks were panic selling mortgage-backed securities in 2008 and 2009, that created generational buying opportunities for investors who understood value and had the courage to act. However, and this is important, you also can't simply assume that the institutions are wrong and blindly take the other side of their trades. Sometimes institutions are selling for very good reasons, and fighting that selling pressure can be painful and expensive. The key is to do your own analysis and make decisions based on your own investment thesis, time horizon, and risk tolerance. So let me give you a framework for thinking through this situation. First, you need to determine which of the scenarios I outlined earlier you think is most likely. Do you believe Morgan Stanley is selling because they're bearish on silver's price prospects? Do you think they're trying to exit ahead of some structural problem in their own positions? Or do you believe they're repositioning ahead of a physical paper disconnect? Your answer to this question should drive your entire approach to the market. If you conclude that they're exiting because of structural problems in their own positions, then the implications are more complex. On one hand, structural problems at major banks can create systemic risks that affect all markets. On the other hand, those structural problems might be specific to the way they've structured their trades and might not reflect anything wrong with silver itself as an asset. In fact, if major banks have been artificially suppressing silver prices through questionable trading practices, then their exit from the market might actually remove that suppression and allow prices to rise to levels more consistent with fundamental supply and demand. If you conclude that they're positioning ahead of a physical paper disconnect, then the implications are potentially very bullish for physical silver, especially if you're willing to take delivery of actual metal rather than just holding paper claims. Because in a scenario where the paper market breaks down and physical metal becomes scarce, the value of actual coins and bars in your possession could increase dramatically relative to the paper price. We've seen this dynamic play out to varying degrees in markets like rhodium, palladium, and even gold at certain points, where physical premiums exploded relative to spot prices. Let me also address something that I know some of you are thinking right now. Could this memo be fake? Could this be some kind of elaborate manipulation attempt to influence retail investor behavior? It's absolutely a possibility I've considered, and it's why I've spent the past 3 days trying to verify as much of this information as possible through independent sources. What I can tell you is that multiple people I've spoken with in the commodity trading world have confirmed that Morgan Stanley has indeed been a significant seller of silver in recent weeks. I've also been able to verify certain details in the memo against publicly available trading data and found them to be consistent. Does this prove beyond all doubt that the memo is authentic? No, but it gives me enough confidence to bring this information to you and let you factor it into your own analysis. I also want to talk about the timing of this liquidation because it's actually quite interesting when you look at what else is happening in the broader market. We're currently in a period of significant uncertainty across multiple asset classes. Bond markets are adjusting to a new interest rate environment. Equity markets are trying to figure out whether we're heading into a recession or achieving a soft landing. Real estate markets are showing signs of stress in various regions. Currency markets are experiencing unusual volatility. In this kind of environment, investors typically look for safe haven assets, and precious metals usually benefit from that dynamic. So the fact that Morgan Stanley is liquidating silver right now, when you might expect defensive positioning, is particularly noteworthy. There's also the relationship between silver and gold to consider. Historically, the gold to silver ratio, which measures how many ounces of silver it takes to buy 1 ounce of gold, has been an important indicator of relative value between these two metals. That ratio has been quite elevated in recent years, suggesting that silver is undervalued relative to gold. If Morgan Stanley believed that precious metals broadly were going to decline, you'd expect them to be selling both gold and silver. But from what I'm hearing, Their gold positions aren't seeing the same kind of dramatic liquidation. This suggests that whatever is driving their silver exit is specific to silver rather than a broader view on precious metals. Let me share one more piece of information that I think is particularly revealing. According to the memo, Morgan Stanley has instructed their traders to execute these liquidations in a way that minimizes market impact and public attention. They're apparently using algorithms that break up large orders into smaller pieces, timing their sales to coincide with periods of higher liquidity, and utilizing dark pools and other venues where their activity is less visible. This tells us two things. First, they clearly don't want other market participants to know what they're doing, which suggests they're worried about triggering either a panic or an opportunistic response from other traders. Second, they're willing to accept less favorable prices in exchange for stealth, which again suggests urgency. Now, as we approach the conclusion of this analysis, I want to bring this back to practical action steps. If you're currently holding silver, should you sell? If you're considering buying silver, should you wait? If you have no position, should you avoid the market entirely? These are the questions I know you're grappling with, and unfortunately, I can't make those decisions for you. What I can do is give you the information and framework to make informed decisions yourself. Here's what I'm watching over the coming weeks. First, I'm monitoring whether other major institutions follow Morgan Stanley's lead. If we start seeing similar liquidations from JP Morgan, Goldman Sachs, or other major players, that would suggest a broader institutional consensus that something is wrong. Second, I'm watching the physical market closely. Are premiums on coins and bars rising or falling? Are delivery times getting longer or shorter? Or industrial users showing signs of panic buying or demand destruction? Third, I'm looking at the technical picture. If prices break below key support levels on heavy volume, that would suggest the selling pressure is overwhelming. But if prices hold despite institutional selling, that would suggest strong underlying demand. I'm also paying attention to any official statements from Morgan Stanley or regulatory filings that might shed additional light on their positioning. Banks are required to disclose certain information about their commodity holdings, although there are significant time lags in that reporting. If we see unusual patterns in their upcoming filings, that would be an important data point. And finally, I'm keeping my ear to the ground for any developments in the mining sector, industrial demand trends, or geopolitical factors that might explain the urgency of this liquidation. The bottom line is this. Something unusual is happening in the silver market right now, and Morgan Stanley's behavior suggests they have significant concerns about their exposure. Whether those concerns are justified, whether they reflect bearish price views or structural risks, and whether this creates opportunity or danger for retail investors remains to be seen. What I do know is that ignoring this development would be a mistake. This is the kind of signal that deserves your attention and warrants a reassessment of your thesis on silver.